This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Mebane Faber. Mebane is a portfolio manager. He is with Cambria Investment Management. He also writes, noted author, a book that I definitely recommend that you pick up called The Ivy Portfolio. If that doesn't ring a bell in terms of the importance of that title, we're going to be talking about that. And Mebane is quite frankly has become a very influential blogger as well. I think his stuff, if you are into quantitative style investing, trend following, systematic strategies, and just that overall kind of, hey, let's be real, and that skeptical feel, Mebane is right there. And he happens to live in a very cool place, Manhattan Beach, California, and says he has become a pretty good surfer. Did I get that right, Mebane?
Well, everything except the good surfer part. I grew up in the mountains, so I haven't quite picked up the surfing that great yet, but I'm learning.
So, well, where do you stand on the surfing right now? How long have you been in Manhattan Beach?
I've been here about 5 years, so I picked it up, but it's a little June gloomy right now. I haven't been out in a while, so I need to get back out there. It's been too long.
So we just did a quick switch there. Hopefully it will be completely seamless to you, the audience, but we jumped off Skype and we went to landline because apparently in Manhattan Beach, California, they're having technology problems. Apparently it's very close to, I don't know, the middle of nowhere, that there's no wealth in Manhattan Beach. There's no nothing, right?
Backwoods, I guess.
It's kind of a backwoods type place. So as you were saying, though, have you got some surfing skills so far?
I'm picking it up. We started doing a little stand-up paddleboarding, so I've done that about half a dozen times, and that's pretty popular these days. You can get out when it's flat, but it's getting ready to be summertime here once the June gloom passes. So I'm ready to get back in the water without a wetsuit.
Well, listen, I gave that introduction. I know you're into a lot of different things in terms of what you do. I think primarily, I can't speak this morning, primarily as a portfolio manager. But take me back, because I think people always want to know, okay, this Mebane Faber is a portfolio manager. He's written this book. Where was the start? Like, what were you doing at 13 or 14? I mean, did you see this ultimate move to where you're at today? What was going on?
Well, I mean, I think like a lot of people, the first exposure to investing often was, your parents or whatnot. My father was an aerospace engineer guy, and so we used to always chat about investing and stocks and whatnot. And I spent the majority of my adolescence, in a raging bull market, graduating college in 2000. So the majority of my formative years, I used to talk to my mom about it. My mom would always say, look, the way you invest is you buy a stock, you hold it, and you just put it away. Well, 20 years later, you look back at that, and she was incredibly successful doing that. But, she grew up in Winston-Salem, North Carolina, and her family worked at R.J. Reynolds, and was, one of the better performing stocks of our generation. So she has a very, biased view. It worked out great for her. But so like a lot of people, you get your initial preconceived views from your family or relatives or friends or whatnot. And so I grew up in a fairly interested family for investing. And the family full of engineers. So as I, went to college, University of Virginia, I was studying engineering and biology. So biomedical engineering was kind of my fascination, but had always had this very strong financial interest. And so I used to spend a lot of time, especially in college, really researching biotech stocks, which, can be about as difficult or exciting or devastating as, any other market there is. And so you spend a lot of time with the annual reports and the science of it. And this time was very exciting in the investing world because it was the genome was getting sequenced, as well as the internet was really starting to take off in the year 2000. So the internet bubble was really taking full force. So pretty crazy time to be, kind of like learning the basics of investing. And at the same time, it also taken a few investing classes, one of which sowed the seeds for some investing ideas that would take place a decade later. But there was a hedge fund security analysis class taught by one of the former Tiger Cubs. So Blue Ridge Capital, John Griffin. So he would teach it from New York. And so I was the token science guy. Everybody else was in the business school, but got to get a lot of exposure to some early ideas on the equity and fundamental research side. And so it's kind of this amalgamation, very typical learning process as an adolescent, but combined with kind of a more atypical engineering background. And then, not to go on too long, but as my career started in the biotech space, started out as a biotech equity analyst, and then quickly or slowly, depending on your time frame, gravitated more and more away from the science side of the business and more towards the pure quant investing side of the world. And now you could probably say my hobby is my career, and vice versa.
One of the things that I think really, I think you're going to agree with me here. I hope so. That really started to put your work on the map was a white paper you did. I'm guessing this is about 6 years ago that it originally came out, called A Quantitative Approach to Tactical Asset Allocation. Now, to the uninitiated, that's a fairly scary title, but why don't you explain where you were going with that, and what was the ignition point for that?
It's actually kind of a funny story, and I don't know how many people know, but we had really no intentions of publishing a lot of our work, and we did most of the quant research here, and I think we were writing it. This must have been 2005. And I had been through the Market Technicians Association CMT program. For those who aren't familiar, it's a Chartered Market Technician. It's kind of like the technical analysis version of the CFA. It's a 3-year program. There's a curriculum, but at the third level, you can either take the third level test, which is essays and multiple choice, or you can write a paper. And there's a lot in the TA world that I agree with, and there's a lot I really kind of firmly disagree with. And so, like many courses as an undergrad or in high school, when you really don't want to study something, it's your worst nightmare. So I really wanted to write a paper, but kept putting it off. And then they announced they were going to get rid of the paper requirement at the end of the year. And so it was probably December 29th. I tossed in an abstract. I said, what are we doing here right now that I could write up something easy on, that's not too complicated? And, and so we threw that in, and it ended up being this paper. And it's funny because after we written it, we said, well, this is actually kind of, some people might find this interesting. And so we said maybe we'd submit it to, one of the academic journals or whatnot. And I can't even remember, 26, 27 at the time, and not come from the financial publishing world. And if you read a lot of these academic papers, it's a very strict way they look at formatting and style, and there's a very process you use for that. But my original title for the paper, I think, was A Quant Approach to Market Timing. And like a lot of things in our world, as well as politics and religion, certain phrases have an enormous amount of emotional baggage attached to them. Using the phrase market timing, to a lot of people, it just immediately shuts down all of their synapses in their brain. So once we changed the title to A Quant Approach to Tactical Asset Allocation, it became much more palatable to people. But anyway, so we published in the Journal of Wealth Management in 2007. I think one of the reasons it became fairly popular is, look, nothing we did in the paper was anything particularly new. It's very just simple trend following approaches that have been around for, over 100 years. I think one of the things that just resonated with people is that, we wrote it in a style that was not like most academic papers typically are written. So we tried to make it as clear and as simple as possible, and really distilled down a lot of the reasons we thought trend following works, which is different. Even though many CTAs have been pursuing this for decades, we think that just some of the very simple conclusions we had from the paper resonated with people. And then, of course, the biggest reason for the popularity of the paper is it came out before the 08-09 mess, and would have done a fine job of sitting through that. I think in 08 would have been the basic system published there would have been flat. So it was kind of a strange route to publication, but it ended up benefiting us far more just from the people we've gotten to meet and chat about it and send in all sorts of crazy extensions to the paper that we never even thought of.
Let me address a couple things you just brought up, and maybe we'll go into some of the conclusions too. But you mentioned the idea of timing versus quant. Why don't you speak to that issue, the lesson that you learned, and maybe speak to why there is this perception issue with these phrases?
Well, then there's a lot that can really, incite people. I mean, just saying fundamental or technical, or saying, active versus passive, that's one of the biggest. And it's always strange to me, because to me, absolutely nothing out there is passive. Everything has buy and sell rules. They have, it tends to be whether it's objective or subjective. And then you can get into any sort of rules. I mean, if you look at the S&P, that's an active system. If you look at, every index out there, it's an active system. So it has always been challenging for us to, we've kind of learned to be able to talk with a lot of the, reporters or whatnot about the lingo. But when you get to say quant versus market timing, the typical baggage people have associated with it is that, you're subjectively trying to pick or guess turning points in markets. You're saying, look, I'm long gold because of XYZ or whatnot. And historically, both people and individual retail as well as institutions have been horrible at it. If you look at a lot of the Dalbar studies, if you look at the investor returns in mutual funds versus the time-weighted returns, they're horrific. I think one of the, that people consistently chase and herd after asset classes. So it was very important to us, just to say, look, you can have a market timing system that says basically when to get in and out of markets. That's objective, that's not, you waking up and looking at CNBC in the morning or whatnot, that works and has worked for very long periods of time in every market that we've tested. So
you sound so rational about this. So matter of factly, it's worked for 100 years. I mean, people don't just generally accept that, Mebane. You're saying it's worked for 100 years. I mean, do you realize how different that sounds to maybe the average person?
Well, and the thing is that one of the benefits of not coming from a finance background is, I wasn't really indoctrinated with a lot of what's considered to be, market basics or wisdom. And not to go on and on about the efficient markets and modern portfolio theory, because there are a lot of things right about most of the theories that are accepted, but, there's a great quote, I think it's Ray Dalio, who runs the biggest hedge fund in the world. He says, look, every market's great sometimes and horrible other times. And so it's very much like anything else in life. It, very much depends on what you pay for it. And so we try to be, and not just market timing, it often shocks people to say that, look, I have no problem with buy and hold. In our book, we outlined a lot of portfolios that people could use as buy and hold and probably do just fine. But the challenges with a lot of buy and hold portfolios tend to be much riskier than people think they are, and the amount of loss tends to be usually much higher. So, we think that in general that any investment approach, it doesn't matter what it is, has to have a fundamental reason why it works. And so coming to any sort of endeavor, whether it's investing or becoming a doctor or whatnot, having a blank slate and saying, hey, look, I'm just going to let the data speak for itself. I'm going to be able to find out what works rather than just what I've been told, can end up, I think, being really important to the end investor. And at the end of the day, the people have to find something they're comfortable with. But in general, investors are their own worst enemy, and being able to determine that.
let me go into something, because I think this really gets into your wheelhouse even more. As we expand upon this white paper, you start to develop a following and start to pick up more and more recognition for your work. And I guess the culmination of your writing would be your book, and it's called the Ivy Portfolio. I mentioned it in the intro, and I think the interesting thing about this is, if you hear that phrase, the Ivy Portfolio, you might not go, okay, what is this? Well, it's Ivy League portfolio. And ultimately, Wall Street folks know about this, but the average person might not be thinking that that basically Harvard and Yale's endowments, and other endowments too, are run as essentially hedge funds with very, very, I don't know what the best word would be, strong strategies, strong foundations. And so I think where Mebane goes with this book, and I'm going to generalize here at the beginning and let him expand, is essentially to say, okay, geez, when there's a down market, when there's a bear market, how are these endowments doing so well? Would that be a fair way to lead into?
Yeah, and so what we set out to do in this book, and it probably should have been 3 different books in retrospect, but we wanted to, it was our first one, so we're excited and wanted to put as much in there as possible. But we said, look, and Charlie Munger has a great quote, and I'm going to paraphrase on my blog, but he basically just said, I was just at the recent Buffett or Berkshire meeting, and he basically says, look, you're basically an idiot if you don't look to the smartest investors over time and see what they've done right and try to at least not necessarily copy or emulate them, but learn lessons from what they've done. He's like, why would you not do that? And this is coming from one of the most successful investors ever. So what we set out to do in this book is say, look, there's 3 determinants of portfolio's performance. It's asset allocation, market timing, and security selection. That's it. And we said we want to demonstrate what's kind of has been some of the best methods in each one. And the latter, most academics accept that pretty much all the portfolio's return and volatility comes from the asset allocation decisions, and that market timing, security selection is there's nothing you can do there. And we disagreed. So we wanted to propose some novel ideas in each of those 3 areas. And so the asset allocation, we said, look, Harvard and Yale have been spectacular at investing over the course of their history, and they've done a really good job. And when you say the endowment model, or say the Yale model, which is popularized by David Swinson, who's the CIO, it's really a couple characteristics. One is it's not just investing in U.S. stocks and bonds, but diversifying globally across all asset classes. So they're very heavy into real assets, so real estate, type of securities and property, as well as commodities. They have not just a U.S. focus, but a global focus. And because of the endowment, at the end of the day, their biggest enemy is inflation. And most investors, their biggest enemy over time is inflation. But they also have they pursue active management where it's possible. So if you look at the asset classes where active management makes the biggest difference, so venture capital or somewhat illiquid or poorly followed markets, microcaps maybe, or certain global markets that haven't been developed, and then one of the things that they have is a very small allocation to bonds, typically, because bonds in general don't protect the portfolio that great against inflation for long periods. 10, 50, 100 years. They often say their time frame is forever. So we said, look, and these guys have done fantastic, 15% returns for the past 20 plus years. So we said, all right, so coming at this one again from a scientist perspective, can an individual investor replicate what these guys have done? If so, how would they do it? And if not, why not? And so we kind of went in and back tested a bunch of portfolios and said, at the very basic, with publicly available indexes, so Vanguard funds or PIMCO funds or Barclays, whatnot, mutual funds or ETFs, an individual could put together a portfolio. Now, and I exclude the hedge fund and private equity component because they're not available to most retail investors. But say, just have this global asset allocation, and you pretty much peg the returns of the average endowment, which is good, which is a good, nice, diversified portfolio over time. It doesn't quite get to the Harvard and Yale returns, but a lot of that is due to the private equity. And then a buddy of mine here, Peter Modena, has gone a step forward and said, all right, we're going to bias the portfolio to a couple tilts. So instead of just U.S. stocks, we're going to tilt it to value. Instead of XYZ, we're going to tilt it to small cap to more reflect what their theories are. And he finds you can come really close to Harvard and Yale's returns and by adding a tiny bit of leverage, and it mimics them very well. So with publicly available ETFs and mutual funds, you can get the broad asset class exposure. Now, however, there is a couple very clear in 2008, 2009 made this is front page news. A couple drawbacks to the endowment style allocation. And so, by the way, Swenson's written 2 books on the topic. Muhammad El-Arian, who used to run the Harvard Endowment, wrote a book on the topic. They both suggested individual portfolios for retail investors that actually came very close to our generic allocation. And by the way, generic allocation ended up being about 1/5 in each: U.S. stocks, foreign stocks, bonds, real estate, and commodities. And then if you can tweak the sub-asset class holdings in each. But so what we then said is, look, there's 2 very real drawbacks to this portfolio. One is a deflationary environment where real assets and equities get hammered and bonds do really well. We haven't, in the U.S., hadn't seen that environment since the 1930s. However, Japan has been going through it for the past, 20 plus years. And most people thought that couldn't happen really here. And then lo and behold, what happened in 2008, 2009, and then also made evident their second big drawback, and that is illiquid investments. So they have a lot in private equity, a lot in hedge funds that you can't necessarily liquidate if you wanted to, and so you have to manage your cash a little more intelligently. So a lot of these endowment-style allocations, they only publish their results once a year, declined because some of them admitted it, and then some of them, we can track with our public portfolios, probably had 50% losses at some point. And then you start to get into some philosophical, questions on should, an endowment with $25 billion be risking, their assets at all? Should they just be sitting in, tips or something? Well, I'll leave that to, the board of visitors or whatnot at these universities. But so then we moved into the second and third parts of the book, which is the second part of the book was, a market timing solution, and you could overlay. So you could call it risk management, call it tactical asset allocation, call it market timing, on top of the endowment style portfolio. I'm happy to keep blabbing or get into that. No,
I just wanted to get this conversation started because what I've got in front of me right here, I've got a couple of your research reports that you put out on a monthly basis, and one of them that I'm looking at is going into exactly what you're talking about right now, which is kind of what this is affectionately called "Where the Black Swans Hide" in the 10 Best Days myth. And I think that starts to get into the timing element, and maybe you can kind of expand into that area. I mean, would you say that's one of the downfalls the endowment direction has? Is it doesn't necessarily account for that?
Well, so any allocation is going to have its natural biases. So, and it's funny because based on the times and whatever asset class is doing great, people herd into that and talk a lot about it. It may be gold in the last year or two. It may be real estate in 2007. It may be internet stocks in 99, Japanese stocks in the late 80s. I mean, it just, rinse, repeat. It happens over and over again. And so the allocation that's become really popular in the last year that you've heard a lot about is the so-called risk parity allocation, which a lot of institutions follow, and they're launching lots of funds on. And kind of, it's a kind of a I don't want to say competitor to the endowment style allocation, but a very different thought process in that is the quick takeaway. We have a couple of videos on our blog that talk about it called dynamic risk parity, but it basically ends up with a lot more in bonds or government bonds. And so that did fantastic last year because 30 years did something like 20, 30%, zeros did 50%. so in a year where bonds do fantastic, allocations that have high exposure to bonds, 60-40, risk parity, whatever it may be, look brilliant. And then in years when there's massive inflation and real assets do great, an endowment-style portfolio is going to look better. So it very much, Howard Marks has a great piece recently that talks about this, that says it very much depends on your time frame and depends on when you look at these sort of types of events. But yeah, these endowments would have lost probably, had down years, 08, 09, and, probably lost a third of their money. So getting into what you're talking about, the black swans, which is another one of our papers, and going back probably 15 minutes when we were talking about market timing in general. Many people talk about market timing, and especially a lot of the academics and Mark Holbert, who I think is a great writer, but writes about newsletters. Unfortunately, he keeps writing about this and kind of missing the mark on it. Is that most trend following type of systems, and I'm going to be generic and say a moving average type of system, but if you could do any type of trend following system, so a breakout or a volatility based systems, at their very basic level, are not, so just applied to one market, just say U.S. stocks. A trend following system on U.S. stocks, at its definition, is not a return-enhancing type of system. Now, it may, and it usually does, increase returns, call it 1% or 2% a year, compound returns, but that's not the biggest benefit and not really the point, in my opinion. What it does is it reduces the volatility of that equity curve, usually by about around a third, and reduces the drawdown by about half. All right, so on any one market, that's a pretty good improvement. And then when you add that together in a portfolio, you end up with a much better portfolio. And so when you're looking at what a lot of the writers who kind of, and academics who look at trend following or look at a lot of these market timing systems, they almost always focus purely just on the compound return. And that's not really the point, in my opinion. We looked at these across so many markets. The point is that you can lower your volatility, lower your drawdown, and then if you want to increase compounded returns, there's a few things you can do. You can use a relative strength approach, so invest in only the very top markets, and we find across the board that can increase returns by, say, 3 to 4% a year. So getting back to kind of this theme of timing in general and black swans is that, so if you realize that the point of market timing in general is that it reduces volatility and reduces drawdown. And I know you're familiar with the Longboard, formerly Black Star guys, but they've written a couple good papers on this topic, is that if you look at any market, when you say, why does trend following work? And you could say, well, here's all the 10 statistical reasons. It's because markets are not normally distributed. It's because markets have fat tails, and all these topics have been known for 60 plus years since Fama was writing about this in the 60s. Markets have these big, massive outlier events. Well, okay, so trend following works by chopping off those type of events and you don't get exposure to those. Okay, great. But what's the fundamental reason behind that? And if you look, there's starting to be a lot of really interesting research in the past 5 or 10 years. Andrew Lowe talks about this from MIT, where they do these brain imaging scans of people when they're making money, people when they're losing money. And people when they're making money that are thinking about, the new surfboard they're going to buy, the vacation they're going to go on, how smart they are, how can't wait to get in the office and tell my office mate about how I shorted Facebook or, bought gold when it was at 900. It stimulates a totally different part of the brain. It's the reward type of the brain, versus when you're losing money, it's very much the fight response. People aren't opening their statements. They don't want to talk, don't want to turn on CNBC. They talk about how much of an idiot their neighbor was for recommending CMGI. They have a feeling of revulsion and nausea often. So if you look at the actual statistics, and we're starting to get into the black swan type of concept now, is that markets are much more volatile as they're declining. So after they're declining, so let's use, say, 200-day moving average. So after markets have already started going down, they explode in volatility and get much more volatile. And the reason because of that is this flight response, is because people transition from this I'm brilliant, I've made a lot of money, to I'm an idiot, I have to run away, I'm going to lose all my money type of response. And so if you look at, and we're going to call these tail returns or black swans or whatever, if you look at the worst 1% of returns in any market, and this happens on not only a daily time frame but also monthly, or even the 0.1 worst percent of all days, about 70%, it varies by market, but it's around 2/3 to 70% of the worst days, worst months occur after the market has already been declining. All right, and the ironic thing is about 2/3 of the days, the best days, occur in the same period. So it's not because anything crazy necessarily has happened. It's just because the volatility has expanded and people don't know what to do. And so
expanding on the downside.
Both sides, actually.
Yeah.
So in what you find that is, if you sit out these highly volatile periods, you end up compounding your money at a higher rate because they call these volatility gremlins. This volatility will affect your compound return. And so if you can sit these out, and so if you remember back to the fall of 2008, markets are going up and down 5, 6, 7% a day. And so what a lot of the buy and hold advocates will often use in their, and we talk about this in the paper, is they say, if you just miss the 10 best days in the market in the past, 20, 50 years, your compound return goes from 8% down to 2%. I'm just making these numbers up, but it's for illustration. And they say, therefore, you have zero chance of missing these 10 days, predicting them out of these thousands and tens of thousands of days. Therefore, market timing is impossible. Well, what they miss, the whole point is that, well, if you can identify when the majority of these happen, I say, well, first of all, they never mention what happens if you miss the 10 worst days. Your return goes from 8% a year to 18% a year. So what we basically said is, look, if you can miss the majority of the best and worst days, it increases your compound return, say from 8 to 9 or 10%, but it also massively reduces the volatility and drawdown. So it's, learning not just, why trend following works statistically across markets, but why there's a fundamental reason that underlies human behavior that is highly unlikely to change, and why it's going to continue to work, gives someone, much more comfort, at least, from portfolio design and management standpoint, when investing, than some indicator that, you say, will it work in the future? I don't know. But any investment approach, whether it's value investing or trend following, once it has this fundamental reason that it works, I think it gives a lot more comfort to the investor that it'll continue to work in the future.
You're talking about the human element, behavioral finance, behavioral economics, however you want to phrase it. And I want to let you expand on that a little bit with an example from another one of your papers. And I'm just going to read this really quick, but it's a chart, or it's an image that you have of the South Sea stock, and I believe this would be of Newton. Mm-hmm. And the way the chart says is, it says it's down low. Just imagine everyone out there imagine a typical bubble, straight up, straight down, .com stock, that kind of thing, whatever. So at the bottom it says, Newton invests a little. Newton exits happy as the market starts to go up about 20% up the peak. Newton's friends get rich. That's about 50% up the peak. Newton re-enters with a lot, about 20% from the peak. Then you hit the peak, and on the way downside, you can see this at Mebane's website. You can see this paper. And then on the downside, at the very bottom of the peak, imagine at the bottom of a .com stock that's done the full up and down, it says Newton exits broke. And I think that's what you're getting at with the behavioral element right there in that little description.
Well, right. I mean, and how many people can relate to this, on so many different fronts where, real estate in 06, 07 is a perfect example. How many people started buying a houses they could afford, or a second or third house, and flipping them that had no business or experience in real estate. How many people were trading internet stocks and getting involved in investments where they have no business or a fundamental understanding of what's going on. And so what we're trying to illustrate in this paper, and the name of it's Learning to Love Investment Bubbles, is that bubbles have been around ever since humans have been investing in markets. And so it's a property we see that we don't think is going to go away anytime soon. So the example we give is South Sea stock in the early 18th century, and we're just going to show that this market that, I think it was an 8-bagger at one point, gone up hundreds of percent, and then, of course, crashed spectacularly, and most investors lost the majority, if not all, of their money. But what the demonstration you just gave was that of someone who, in this, one of the most brilliant scientists of our time, invested, made some good money, exited, but saw the mania, saw his friends making more money. And it's really hard to sit out those, the emotional aspect of investing, getting out of that way is by far the biggest difficulty for most investors. It's exciting, it's emotional, and there's nothing worse, right, than seeing all your friends get rich and you not. That's probably the worst thing that could possibly happen, is your neighbor coming over and say, "I told you so." And so this is a classic example of about 5 different behavioral biases all wrapped in one. And the last one being is that people are much more reluctant to sell their losers than they are their winners. And so people, in this case, but you could substitute CMGI or any other solar stock recently or whatnot, but goes from 100 down to where you bought it down to 80, and you say, "Oh man, I should have waited a week or two and bought in," or whatnot. And then it goes down to 60, and you say, "Man, my broker's an idiot for buying that, and I'll sell it when it gets back to 80." And then it goes down to 40, and you say, "Well, there's no point in selling it now. I've lost the majority of my money. I just, what am I going to do with this money now?" And then it goes to 0. And so, this happens time and time and time again. And we say, look, if you can have at least an objective process, it may not be the best process, and it may be difficult, and a lot of people will be, they'll never be able to follow it. But we say, look, and the example we give is a 200-day moving average. It's something that's been around forever, and apply it hypothetically to this stock, and you still would have ended up with a really nice profit. And it's very difficult for a lot of people, because most investors, return following is difficult because they'll never get out at the exact top. They're going to end up giving up X percent on the way down, but you would have preserved at least your money.
Hey, Mebane, let me switch you on a side note here. So
sure.
We're talking about sources of trend following returns, and you're laying out the human element. And you mentioned the guys at Longboard, which would be Cole Wilcox and Eric Crittenden. And I was on a panel with the two of them not too long ago up at Stanford, and we got into that very subject. And I'm just curious from your perspective. I don't think you're going to disagree, but I just like your opinion as well. And Eric brought up a really interesting explanation for the source of trend following returns. And that particular day, and I'm sure he would agree with you as well, that there's a behavioral element, a huge behavioral element. But that particular day, what he was demonstrating was more of the source of returns coming from the act of hedging by other participants out there. I wonder if you might speak to that some.
And I think it depends on the market. Is he talking about equities, commodities, across the board?
He was just looking at across the board types examples with a lot of different types of markets.
Well,
mostly commodities, probably.
Right. Well, the interesting thing about the active hedging, or however you may trade it in the trend following examples, is that you're long a lot of these. There's unlimited upside. So there's very much these massive compounding gains. And from some of their papers, some of the best examples they give is, the very few massive winners, the Apples of the world, the gold recently, ends up driving the returns of the indices. And so by having a trend following perspective, you're going to end up owning those by definition. If you look at the S&P 500 as a trend following index, people won't admit it, but it's a trend following momentum type of index. And by exiting or having exit methodology, and I'm not sure if I'm quite touching on the exact topic he was talking about, but by having exit methodology, you're capping those losses at a certain percentage, and so
for example, he was going, just so we could clarify real quick. He was going into, for example, like large corporations that might have inputs, various commodities that they might have to purchase, and they're having to hedge to make sure they can, the typical farmer analogy in the futures markets. Mm-hmm. I just didn't know if you might.
So this is actually, it's an interesting example because it also gives you some structural differences in markets. And so one of the things, that we've spent a lot of time with recently in the past year is currencies. And this is an area that most investors have zero familiarity with, which is a bit odd because you spend more time probably with currencies on a daily basis than anything else. Looking at the participants in a market, and so say currencies, for example, the biggest participants are not people that are profit-seeking. It's massive governments and massive corporations that are hedging or, just entering the currency markets for, whatever their specific purpose may be. And the same thing in commodities markets. So there can end up being some structural, risk premium that's available to investors by realizing how these certain participants, will enter trades or hedge. And so what I'm guessing that he was referring to, and I'm not certain, is that, a lot of markets, commodities markets especially, the exposure of a lot of the participants may be different, and you can be able to extract some certain types of profits through various forms of trading that ends up taking advantage of that. And I'm not quite sure if I got it right.
Yeah, no, I was just curious if you had any perspective. Essentially what you said, and it was basically via a trend-following type strategy. This is essentially a source of return, one source of return. Let me shift gears on you again, because you've got so many different perspectives. I mean, I love this because it's kind of how I look at things. But there's something I noticed on your blog just the other day, and I really like this, and I actually threw it on my site too, linked into it. But you had this great phrase, macro, and because we're going to somewhat run out of time here eventually, but you had this great phrase, macro pessimism, micro optimism, and you were basically saying, man, this news, this negativity, the big macro stuff, the world's going to end, Chicken Little, Mayan 2012, whatever. I don't think you said Mayan 2012, that's me. But anyways, but you said, but from an individual perspective, I could never be more optimistic. And I think as somebody who is an independent entrepreneur, and I know you and your firm are as well, and it's all about having this platform to kind of educate and give other people an experience. But speak to that notion of your optimism as an individual, as an entrepreneur, as somebody who is just making your way. I think it's a really important point that maybe we all, in the midst of a lot of the very formal discourse on investing, there's something to be said about spirit and just optimism.
Yeah, I mean, I think it's interesting because if you spend a lot of time and getting exposure to a lot of the financial media, so much of it tends to be negative, and that's because of what tends to sell. Sell. You go on CNBC, and it tends to be really negative stories or just fantastic stories in general. And so, a lot of the macro news is almost always consistently negative. Now, this hasn't changed. I mean, this has been true for, as long as I can remember, and the stories may be different. It may be Japanese tsunamis. It may be a massive, World War II. It may be incredibly stupid things politicians are doing over and over and over again. So it's kind of this steady stream. And it feels like particularly now it's been pretty terrible. But at the end of the day, if you look at a lot of the things that are going on in the world, and I was in this post was talking about kind of a lot of the young entrepreneur type of ideas that are going on there. It's so hard not to be optimistic. It's so hard not to be incredibly excited about the future. I mean, last night I was reading the recent Wired magazine. It was a profile of Craig Venter, who back in the day was at Solera, and he's now talking about, the time when they sequenced the genome, and I was in Maryland, in Bethesda, and taking grad classes at Hopkins at the time. So when this was going on, he said, it took us, it cost billions. It was for the U.S. government and then Solera to get a very patchwork version of, sequencing a genome. He's like, now, 10 years later, you can do it for $1,000. He's like, 5 years from now, all this information is really going to start to flow through, and are starting to be able to really understand these types of discoveries. And to me, that's just so fascinating. He says, not only that, we're creating synthetic organisms to tackle, energy production and all sorts of other ideas. And so it's to me, markets, look, there's always going to be bubbles. I mean, if you look at, what's going on in Greece right now, or what's going on in Argentina, markets can and do go to zero. And this is one of the things you have to take, as an investor, take a step back and say, look,
Mebane, you got to repeat that again. Markets can and do go to zero. You got to repeat that. I mean, it's true.
So we actually lost a client the other day because he says, "Look, it's a little too complicated for me. I'm going to move to 60/40. It seems safe, and that's that." And I said, "Okay, look, I'm totally fine. I buy and hold. I have no problem with that. I just want to let you know, every G7 country in the world." If you look at their 60/40 allocation, and this is on a nominal basis, this isn't even after inflation, which is going to make it much worse. Every 60/40 allocation in the world has had a 60% loss at some point. And I was like, as a retiree, are you comfortable with that? Are you willing to, experience, can you sit through that? And he said, well, no, of course not. And I said, well, I just want to let you know, take a look at Japan for a perfect example. It's down 75% from its peak in the equity markets. There's an entire generation of Japanese individuals, in my age probably particular, that will never ever invest in stocks. They've seen them just go down year after year. So, markets, and I don't think the U.S. is immune to this in any shape or fashion. But one of the interesting things from being a younger guy perspective is nothing that would be better for me, for my long-term wealth probably, than for markets to go down equity markets, or even whatever markets, go down a lot in the meantime, because that sets the stage for much better gains for the rest of our lives. So take a look. We did a post the other day on the blog where we look at valuation metrics for markets, and there's a professor, Robert Schiller, who does what he calls it's a 10-year earnings, where he smooths out kind of a lot of the cycles of earnings. And historically, markets kind of will around, the average is around 15 to 20. So PE of around 15 to 20 is considered about normal on this 10-year kind of perspective. And he adjusts for inflation. And when things get really, really bad, markets will bottom down around a PE. It's a 10-year PE, but around 7, and have hit highs. They usually peak around the 40s or 50s. And so, there's been higher. Japan, I think, hit 80 at their peak. But if you look at some of the European countries right now, they're getting down into these single-digit valuation metrics. I think Greece was down near 3, which is the all-time low I've seen for a valuation on a longer-term perspective. Now, it may be a little bit different because they don't have their own currency. But so this sort of macro pessimism, the ironic thing about it from an investor standpoint is it often sets the stage for massive bull markets going on for the next, not just 1 or 2 years, but decades. Now, when will that happen? I don't know if that's 2011 or 2015 or 2020, but at some point, the pendulum shifts too far. And a lot of that macro pessimism will start to wash away and turn into macro optimism. But on either case, I'm
but you're chasing that belief though, because I noticed also on your blog you had a post not a prediction by you, but you had another gentleman who had mentioned an S&P target of 400, which is a fairly bearish, macro pessimistic view, if there ever was one. But when you mention these pessimistic and bearish things, and when you link to somebody else's, your strategy, your firm strategy, what you're working with clients about, though, is to only possibly get to that point if the markets go that way and your quant strategies take you that way. Are you laying out a fundamental view on that, or just clear it up for me?
No, I mean our main flagship is purely a price-based trend-following strategy. That having been said, just real quick comment on the example you gave is that there were a couple strategists. One was talking S&P 400, one was talking S&P, I think 2400. And I said the ironic thing is that if you look at the historical, and I again use these Shiller PE ratios, the lows and the highest it's ever been. So, 1999 is in the 40s, and the lows, I don't even remember when, but are down around 5. That's pretty much where they've been. So to me, I said it's very possible. It's totally within the realm of historical example that the S&P could go to 400, the S&P could go to 2400, purely based on people's perception of where it should be. Nothing to do with fundamentals. Just where it has been historically, that range exists. So most people cannot possibly conceive of those events happening, whatever the percentage odds are. I don't care if it's 1%, 0.1%, 0.001%. It's happened in the past. And so one of my favorite authors, Vonnegut, had a book called Galapagos, and he talks about, it's an evolutionary biology book, but he talks about currencies, and he talks about how these currencies crash and it causes world economic problem. He said all that changed was people's opinion of the place. He's like, that's the only thing that changed. It wasn't anything else in the world, but people can have the opinion of stocks and it ends up S&P 400, or they can have the opinion S&P 2400. So yes, our main model is purely trend following at its heart. And in 10 years from now, it still will be. Now, we're launching new funds across lots of different quant strategies. We have a currency fund coming out. We have actually a long-only equities fund coming out. Again, they have to be based on some fundamental principle that we think is timeless. But in general, yes, our flagship is and probably always will be a pure trend following approach.
I do think the point that you make there is so important, because and I do that in slightly different ways, but getting to the same point that you're making, which is if you can imagine markets have extremes on either side, the left or the right side, there can be extremes on either side, then what type of strategy is going to best work for you given those potential extremes? Because I think to be a pure buy and hold investor, I always say, well, if you know these extremes exist and you don't necessarily know when they're going to happen, and you want to call yourself a pure buy and hold investor and you just want to believe in that, well, you must live forever, or you aren't going to ever need your money, or you're never going to retire, or you're going to, or I don't know. So I think you make a really great point.
There's another good example that the timeless wisdom that the Siegel stocks for the long run, that stocks outperform bonds, and up till a few months ago, if you looked at the last, I can't even remember what it is, 24 years 30. I think it's like 30 years where bonds had outperformed stocks. And then Rob Arnott talks about a period in the 19th century when it's closer to, I think, 70 years. So people would always say, stocks for the long run. I say, man, that's a really long run. 70 years. That's probably longer than I'm going to live. But yeah, a lot of markets can certainly take a lot longer to return to normal than most people have time for.
Well, listen, I know I'm going to have to let you run, but I want you to give me one more thing. I'm going to put you on the spot. So what 3 things should people out there be reading? And we've named off a bunch of your stuff, and I'll make sure they get to your website here at the end. But in terms of other people's work, white papers or books, what should they be reading? What's on your desk?
We have a blog. This is actually a really simple but challenging question for me, because I often struggle how to deal with a flood of information that kind of constantly bombards us. But we have a blog roll where we list a lot of the best sites that I really enjoyed reading. I just mentioned a few of the institutional guys that I think are great, that are must reads for us. We've always liked Arnott at Research Affiliates. The GMO guys are great. Certainly the Longboard guys. bespoke. I mean, any of these guys who take a perspective that, look, we're going to take as much history as we can, and really try to understand the driving forces behind, how all this works. And if you look at a lot of these, it's almost a playful passion for history, and so a lot of these pieces end up being almost more historical than anything. But saying, hey, look, we want to understand as much of this as possible. So we've been spending a lot of time with currencies and equities lately, but they're and even a dash of cap-ons thrown in. But there's probably 24 links on the blog of people we like to read. But those are a good few to start with there.
Mebane, where does everyone find you at? Where can we send them to you?
Well, the beach, Manhattan Beach. But our office is there, so if anyone's in town, come swing by and say hello. My blog, World Beta, we try to get out about 2 posts a week, but that's mebanefaber.com, and then Cambria Investments is our website, and we should have hopefully 2 new pieces out in the next month or 2, and so stay tuned. We'll see how the summer goes, but trying to get them out.
Well, I just want everyone to, if you start to listen to this podcast today, just be patient, because I think you really have to pay attention, because Mebane has really there's a lot of detail in things that he's saying, and sometimes you don't just gloss over. Really pay attention. So, anyways, Mebane, listen, I appreciate it, and I will have to make it up your way, and again, or we'll meet up in. I think sushi's on you next time too.
Yeah, I think so. I need to come down for a Broncos game, and when they're playing the Chargers. So I'm up for the next one.
Let's see if that quarterback actually has an arm. If they've regenerated these nerves. Apparently, he's throwing like a 3rd grade girl right now. So I'm not so sure he really got the going, but we'll see.
All right.
Okay, man. We'll talk soon.
Take care.
Okay.
Thanks for having me.
Okay. Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.